Friday, June 26, 2020, Maneco 64, home of alternative economics and contrarian views. So the Federal Reserve has come out with its stress test again. It's a waste of time. Stress tests are a waste of time. And why do I say that? Well, if it was such a good system, why would have they had to bail out the system again back in September of 2019 when the repo market collapsed? We had overnight rates going up to 10%. And what is the repo market for those of you who are not too familiar with it? Well, they're just the rate at which Wall Street banks lend money to each other, not collateralized loans, just unbacked loans. That rate went to 10% overnight in September last year. That meant that the banks didn't trust each other. So are these stress tests really working? No. So what would an analogy for these stress tests be? Well, it's like allowing athletes, Olympic athletes, to continue to compete even though they've been tested for enhancement drugs, steroids, or whatever. And it's like the regulator coming out and saying, oh, they're going to be able to compete. We're going to be testing them. As long as they keep below a certain level, we're going to allow them to keep competing. That's what our banking system is. The Federal Reserve yesterday announced that it completed its stress test. They even came out on Facebook, and I took a screenshot of the Board of Governors of the Federal Reserve System. And it says the Federal Reserve is responsible for supervising and regulating certain financial institutions to ensure they operate safely and can support the U.S. economy. Stress testing is one part of that tough oversight. I'm not going to go over into the exact details, but another reason why it's wasteful is because at the same time we saw news yesterday saying Wall Street turns positive as investors cheer banking rule changes. So on the one hand, the Federal Reserve is saying, oh yeah, the stress tests went really well and they've tightened some of the rules. I think they limited the amount of dividends that the big banks are going to be able to pay. What else did they do? They also put limits or a moratorium on share buybacks, but then they come out and this is what they say. Financials led U.S. markets to their third positive close in 4 days on Thursday as bank stocks were boosted by the easing of post-2008 crisis rules that will make it easier to invest in venture capital funds and free up capital set aside for derivatives. Well, there you go, derivatives. Even more risk. Why? Because derivatives are highly leveraged off-balance sheet transactions. And I know that because I worked in the derivatives market. So I was an exchange-traded derivatives broker or futures and options broker. The over-the-counter market, which is a much bigger market, is probably worth, in terms of notional amount of the bets that they take in underlying markets, because that's what derivatives are. They're just bets on underlying markets like interest rates, like stocks, like commodities. The notional amount is over $1,000 trillion. They tell us that it's around 600 trillion, but these regulators, again, the central banks, the BIS, they changed the rules to make it look like it's smaller, but it's probably now even up to 1.5 quadrillion, which is a crazy number, of course. And that's why the banks will never be safe, not even with its stress test. As I said, a drug addict or an athlete that's taking enhancement drugs, they'll never be safe until they stop taking the drugs, until they get off the drugs. But what the Federal Reserve does is allow the banks to stay on this drug, which is derivatives risk. The Fed even a couple of months ago, they cut reserve requirements for banks to zero. So that means that the banks don't need to keep any reserves on their books. That means your money is at risk in these banks. And that's why I keep telling people to get out of the system. Have as little fiat currency as possible with the banks, just to cover your expenses. And the rest, you need to get out of the system. My favorite way to do it, of course, is through physical precious metals. There are other ways as well. You need to think of what you want to do. Like if you want to pay off debt, if you want to buy land or whatever. It's not for me to decide. It's just to tell you that I think this system is primed for a huge crisis. So what else does this article say that shows me that the Fed is not trustworthy in terms of regulating the banks? Well, it says easing rules on derivatives, meanwhile, is expected to release up to 40 billion in capital for the banks. So there you go. They're trying to ease the Volcker rule from that was a result of the crisis of '08. What is the Volcker rule? Well, it makes it harder, or it bans the big Wall Street banks from proprietary trading, so they don't take as much risk. So it looks like they're gonna ease that rule right now, and they're using this health crisis as an excuse. So what would the advice be for the Fed? Let's say from me, if I'm telling them they're not doing the right thing, I should have a solution to this. Well, it's very simple. You go back to pre-1999, pre-abolition of Glass-Steagall, right? You have commercial banks separate from investment banks. And by the way, it was Bill Clinton under his administration that they allowed for this to change. And it was the big banks, of course, like Citigroup, and I also think like Travelers under Sandy Weil. They were the big pushers for this, for getting rid of Glass-Steagall. That worked very well since the 30s until the late 90s. Is it any wonder that after Glass-Steagall was abolished, that the system became even more volatile, and we had the '08 crisis, and we've had the 2019-2020 crisis. And I say 2019 because it started in 2019 with the repo crisis, right? And that's what happened. So you need to separate commercial banking, or you can even have deposit banking where customers want 100% of their money protected by the banks, 100% deposit banking. I spoke yesterday about Mervyn King's book, the former governor of the Bank of England. He was talking about that in 1933. The Chicago School was pushing, or Irving Fisher, for a return to 100% banking, where banks would have to keep 100% of people's money, so there wouldn't be runs on the bank. Yes, you could have some kind of lending going on in the commercial banks as well, short-term discounted lending for real businesses, like 1 month discounted or 3 month discounted bills. And if you wanted to put your money to work at risk, of course, for 1 or 3 months, you could. But if you didn't, you'd leave your money 100% backed. What about lending to businesses, investment banking? Well, have investment banking, but that's completely separate from commercial banking. That's what you would have had. But what about in a free market? As I've said many times, that the market should decide. Well, in a free market, we wouldn't have a Federal Reserve, and banks could decide to be commercial and investment banks. But I think they would have a very tough time doing what they do nowadays, taking so much risk, having zero reserves. Customers wouldn't go for it. Customers would know that would be very dangerous. The only reason it works now is because they've got this Fed put, or this lender and buyer of last resort in the Federal Reserve. And that's why don't be fooled by all this talk of stress test and that the Fed is doing a great job. They're not. And if they were, there wouldn't be any crisis, especially like we've had this year, where the Fed has had to throw the kitchen sink and a lot more into the markets, right? So let's look at where the markets are this morning. Yesterday, of course, on the back of this headline, the stock markets rallied. The Dow finished up just under 300 points. About 1% the markets were up. So right now it's 8:15 a.m. London time. I apologize for the glasses. It's just that it's so hot here in the UK, in London. Hopefully, I think it's cooling down tomorrow, but it's very hot. So I'm sweating a little bit, which is unusual for this country. So right now we've got spot gold, 1763. It's down slightly, just less than $1. Range has been 1757 to 1768. So precious metals, they've kind of paused a little bit, but they're still doing well. Silver outperformed yesterday, which was good. We're back below 100 in the gold-silver ratio. Silver right now is unchanged at 1779. Range has been 1768 to 1787. The Dow right now is down 190, or 0.75%. S&P is down 0.5% at 3067, and the Nasdaq 100 future is down 1/3%, just above 10,000. It's 10,062 actually. Sterling is down 1/8% at 124.03. The euro is down slightly at 112.08. And the dollar is unchanged against the yen at 107.09. WTI crude is virtually unchanged as well at 38.75. The 10-year yield is unchanged at 0.675. So there you go. Don't believe or trust what the Fed is doing. They're actually allowing the banks to become riskier and riskier. They're allowing the banks to take on more reckless actions and be involved in derivatives. I remember Jim Rickards, who was on Wall Street, who has a lot of experience. He was the lawyer for LTCM back in the late 90s. And he said before that derivatives, especially the financial derivatives, should be basically abolished and banned because they're just speculation and gambling. And I agree with him. Yeah, you can have derivatives for agricultural commodities. That's how it used to be. Farmers hedging their crop, so to speak, and other things, but for real things, but not for things that can be created out of thin air. The more derivatives and risk you have in the paper market, the more dangerous the system is going to be. And that's what we have. Derivatives are just side bets on underlying securities like government bonds, corporate bonds, interest rates, stocks, stock indices, commodities. Yeah, the commodities is different because it's the real world. I highly recommend you watch The Big Short if you can. I think it's on Netflix if you have Netflix, but it will tell you all about derivatives and all the risks involved. And this Big Short, of course, is based on the '08 crisis, what was happening then. And believe me, they haven't done anything to fix that. One of the things, though, was the Volcker rule, but it looks like they want to like do away with all the rules that came out trying to fix the system after the crisis. And again, they're using the current health crisis as an excuse. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, Parlay, which is like a relatively new kind of uncensored Twitter. I joined a few days ago. It's quite interesting. It's not as big as Twitter yet, but who knows? Competition is good. And you can also follow me, of course, on all these other platforms here below. I wish you all a great day. Take care. Bye.